Good morning, everyone. You're welcome to another episode of financial planning today and bookkeeping. I want to apologize for the delay in starting the program as usual. We are going to talk about financial planning in yet another dimension as we discussed today. But at the end of the training program, you should be able to understand the following things that I am going to mention, about 6 of them. One, you will understand financial planning activities. That's the first thing you are going to understand in course of our training this morning, financial planning activities. Secondly, we are going to differentiate between long-term and short-term plans. And then thirdly, we are going to look at understand reasons for keeping books. We may have heard the word bookkeeping over time. So at the end of our training today, you should understand in a more broader sense what is bookkeeping and why is there a reason for us to keep books in carrying out our businesses. Then the fourth thing we are going to discuss is to identify bookkeeping methods. What are bookkeeping methods? At the end of the program today, we should be able to understand that. And the fifth thing we'll talk about is record financial transactions. If you have kept the books, how are you going to record them? So these are the things we are going to look at. And lastly, we will talk about balancing the books. So having got the books, how will you balance them? So these are principally what we are going to discuss this morning. So to set the ball rolling, let me inform you that it will be very difficult for you to run a healthy business without having proper books of account. Why are we saying this? If you are having a business you're running and there is no record, then you cannot even understand whether the business is doing well or not. It is just like driving a car. Upon driving a car and that your fuel gauge is 40 or it's not working, or let's even say that you don't have a map. Now, take fuel gauge, for instance. You are driving to a distant place and they show you all through that your fuel is full because it is 40, or that there is no fuel in your car because it is 40. When the actual thing happens, what will you do? You may not even know when the fuel has finished. You may not even know if it is still inside or not. So that is exactly how it is with running a business without records. You will not know whether the business is doing well or not. You will not know whether the business is lagging behind in some areas or not. So those are the things that financial planning can help you to handle. What about a map? Imagine that even within Abuja here, you want to go to a place you do not know. What will happen if you do not know where you are going and you don't have a map? Sometimes, because of the kind of networking we have around Abuja, the road network we have, you could even go round and round and round without knowing where you are going, simply because there is no map. No wonder sometimes when we are going to a place we do not know from the beginning, we can just turn on the map and it will be telling us turn left, turn right. You are 50 kilometers away from where you are going. You remember those languages that the Google map used to tell us. So that is to guide us to the right destination. And the same thing applies to bookkeeping. If you do not have a book, you can just be thinking that your business is healthy, when in reality, it is not healthy. So that is how it is. It will appear as if your business is doing well, and you will know when you are running into serious trouble with the business. Remember, in accounting, we say that every business should be a going concern. By using the word going concern, we mean that every business should continue to exist into the foreseeable future. No person plans to fail. So if you are running a business, you want the business to be efficient and effective and runs into the foreseeable future. So imagine that this same business, you do not have anything that guides you on the operation of the business, whether it is doing well or it is not. If it is not doing well, you will take intentional steps to correct what is wrong. And that is how the map and the fuel gauge can guide your business aright. So having said this, let's now look at proper what we are going to discuss today, financial planning. Financial planning is when a person who is running a business is able to estimate fund requirements of the business and determine the source for the same. You are able to know that this is how much I will need, and this is where I am going to get the money from. So for you to achieve that, it means that you have to generate financial blueprints for the company's future activity. You need to understand that this is where the money I am going to use will come from, and this is how it will be applied specifically. If such specific application is made on the money haven't gotten, it can guide the business aright. So financial planning, it is like the key to success of a business. Because as Zig Ziglar said, anyone who did not, nobody plans to fail, but that some fail to plan. So if you fail to plan, it means that you have automatically planned to fail. So financial planning is the hub of success for every business venture. Then, if that is the case, it then means that for you to plan aright, there should be some objectives of financial planning. So let's look at objectives of financial planning. What are some objectives of financial planning? We are going to identify some of those objectives of financial planning. If you plan aright, it is going to ensure availability of funds, as you can see on the slide. When a person plans properly, you will know where you will get money from to pay salaries. You will know when it is time to replace your non-current assets, the assets you are using for the organization. You will know whether you should sell a car that you are using for the business and buy a new one. So planning helps you to ensure that the company is always having a float at all times. There is money at all times to take care of your immediate needs. Some of those your immediate needs may be telephone charges, it may be transportation, it may be salaries, it may be rent. So those things need to be planned for, and funds need to be available. Imagine you hired a place. Let's say you rented a facility for your business and you paid for 1 year. Now you ignore the date you entered the place. You did not tell the landlord anything. You did not keep record of that day. And it is from the business you need money to fund the rent. When the rent falls due, the landlord who invested in this structure to earn money comes to you and say, give me the money, and you do not have the fund available. That would be that the person did not plan well. So what we are learning today is that we need to plan aright. We need to plan properly so that funds can be available at all times to meet our immediate needs. Then the second objective of financial planning is that it ensures estimating time and sources of fund. Like we are talking about borrowing from a bank, you know when will the money come? What will be the source of the money? Am I paying back? Will I pay interest? How much is the interest? So those are things that a person needs to look at critically before you venture into a business. And even if you are in a business running already, you need to also look at these things that surrounds your business so that the business can be effectively run. Then the third objective of financial planning is it generating capital structure. If your business is made 60% of debt. That is, you borrow 60% of money that is in the business, and 40 is the one that comes from you. In accounting, we say the business is highly geared. It means you fund the business so much of debt than of capital. Or you could say that the business is thinly capitalized. That is, majority of the money, of the amount used to run the business is not coming from you. So, but if it is the other way around, that money is 60% comes from you and 20% and 40% comes from borrowing, it will not be like that. So we also need to look at the last aspect or objective of financial planning. And the last thing we have here is avoiding unnecessary funds. If you have money lying fallow in the business because you say you want to make funds available, it may not be proper for you to do so. There are other places you can invest those money from that you collect it at any time. So instead of the money, let's say you have 100 million naira, you just kept, okay, anytime I need money, let me pick from here. In a month, that may have generated more than 2 million naira for you if you invest it somewhere. And continuously, you are going to be having returns on it because you did not keep idle money. So if money is not budgeted or planned for at any time, it is proper that that money is used for other better venture, other better activities that can generate money. As they used to say in English, that money begets money. You use money to get money. You spend money in order to get more money. So everything we are doing as business owners, we want to ensure that the business is attuned with what is expected of us under financial planning. We did mention that we are going to look at the difference between long-term and short-term financial plan. But for us to look at that properly, we need to even understand first what is long-term financial plan. So let's look at the financial planning processes. And the first thing we want to look at is long-term financial plans. Whenever you hear the word long-term, what should come to your mind is strategic. Whenever they say long-term, it is associated with strategic. In every organization, let's say a company, for example, there are people who are set to set strategic plans for the business. These are called the board of directors. The board of directors is made up of one who is called a chairman, and that chairman is called a non-executive director. Then it is made up of also an executive director, the one we call MD CEO. He is serving as the head of the management and also as a member of the board of directors. So what is the work of the board of directors? You know, many of the persons who are on the board of directors are non-executive. That means they are part-time people who come in to bring their ideas to the success of the business. So their work falls under the category of long-term financial plan, because they are planning into the long term of the business. Long-term strategic takes about 5 to 7 years. So it is not something that is done in a day. It is something that you plan for a longer period into the future. So what are the things you plan that is not within the short term? One is the first thing that is on the side of strategic plan is proposed fixed asset investments. When you hear the word fixed, it means you are investing in an asset that is going to last beyond one accounting year. When you hear the word fixed, you are investing in an asset that is going to last beyond one accounting year. So what do we mean? Now the word fixed has been changed to the word non-current assets. So whenever you plan to buy a vehicle, you are aware that this vehicle you are buying, it is not going to be with you for one day, and the next day the vehicle is no longer there. It is going to stay with you for at least 4 years or even 5 if you are in government. So planning to buy non-current asset like motor vehicle is strategic, because as I have mentioned to you earlier, that strategic planning is a plan for a longer term that will take you 5 to 7 years into the future. Apart from motor vehicle, there are still other non-current assets like property. When you have a house, houses does not just stay for 2, 3, 4 years and it's off. No, it stays for a longer term. So planning to buy a house for the business is strategic in nature. So if the business is enlarging and you want to buy a house, it means you are also having strategic or long-term financial plans for the business. And you know, buying a house is capital intensive. It is not something that you can just pick money from your business and use immediately. It is something that will take a huge amount of money for you to be able to do that. Apart from house and car, I did mention that a long-term plan in fixed asset, you are talking about property, plant, and equipment. If you're buying an equipment, it is not expected to stay for 1 year. If you're buying a plant, let's say a generating set, it is not expected to stay for just 1 year. So these are strategic in nature. Whenever you plan to buy things that can last for 2, 3, 4, 5, 6, 7, even 10 years in the business, then it is part of your strategic financial plan. Apart from planning non-current assets, the next thing we are going to look at is research and development activities. You know that research is something that every successful business venture must consider. Why do we say this? It is because you cannot just pull a business. Let's say you are having a head office in Abuja. You just say, okay, let me move to Lagos and build and open an office in Lagos. You need to research in Lagos. You need to know which area in Lagos will be very okay for your business. And you also need to look at the demography. What are the type of persons my product will sell to? Who are the kind of persons that will like my product, and where are they concentrated? When we hear people today, you in Nigeria, many persons are running to Canada, Canada, Canada. Have you asked yourself, why are people running to Canada? Why is the Canadian system asking for more hands to come? It is the same issue of demography. Why? Many persons don't give birth to more than 2, 3 children, some even 1. And the majority of the people who are there already are already in retirement age, and many of them don't have more children. So there is need for people to fill into the system so that they can take over their jobs. They have already done that research. That is why they open their border. Please, so if you have the expertise that can add value to our system, please come to our place. They invite people to come. So the same thing is what you are going to do to your business. Instead of you to say, let me just go here and enter the place blindly, you need to research whether the place will be business friendly. Not just business friendly, specific business friendly, because the specific in it is what kind of business are you doing? If you are selling something like sachet water, you're selling pure water, will you need to go to Asokoro and sell it and open a factory? Many people who are in Asokoro may not be buying pure water. They may rather decide to be buying bottled water, is it not? Or even dispenser water. But if you open a factory at Duse, what do you think will happen? You will sell more. So you need to research into the area you want to invest in so that you invest aright. And when you invest aright, you will be happy that you have taken this strategic planning process very seriously. Then the next thing is marketing and product development. Upon marketing, you want to find out where will be the target market of this my business. Where do you think should be the target market? Who are the kind of people I want to sell to? Are they children? Is it children products you are selling? Where will I find more children? Is it teenagers I want to sell to? Is it adolescents? Is it adults, mature people? Where do we find them? And even among this set of persons, classes matters. You need to also know what class of person do I want to sell it to? Is it low income earners, medium income earners, or is it the one that the articles of ostentation, people who shows off? So you need to consider all these things and know where your product can be marketed. Then the next area is now capital structure. I think I have explained capital structure extensively before, where I mentioned to you that capital structure is having to do with either are you financing it with debt or you are financing it with equity. Debt means borrowed fund. Are you borrowing what you're using to run the business? And what is the percentage of borrowed fund in the business? So that is capital structure. Sources of finance is also very close to capital structure. These plans are generally supported by a series of annual budgets. Why is it series of annual budget? Remember, strategic plan we have mentioned that is between 5 years and above. So since strategic plans is between 5 years and above, you cannot just plan once and sit and say, okay, I have achieved my plan. You need a series of smaller plans that will help you to achieve the larger one. Let's say that your strategic plan for a period of 5 years is that you are going to spend 500 million naira in the business. So since it is for 5 years, you cannot just sit and say, oh, I have made a plan, I will relax. You need to break it into year by year. If it is 500 million naira in 5 years, it then means that every year you need to plan, make a series of annual budget of 100 million. So each year, out of the 500 million for 5 years, you will spend 100 million for this year, leaving it to 400 million the next year. And the next year, when you spend it, it will reduce it to 300 million. And the 5-year period is gradually getting to a close. Then what happens when you have closed down on all your planning process? You can plan again. Now, having talked about strategic planning process, then the next planning process we want to look at is short-term planning process. Short-term is operating, it is not strategic. Whenever you have had a strategic plan, you will also need to have one yearly plan, the one they call annual budget. In Nigeria government system, you may have heard them talk about medium-term expenditure framework, the one they used to call MTEF, medium-term expenditure framework. It covers a period of 3 years. It is from those 3-year plans that each year the government now say, okay, this is the annual budget of this year, 10.02 trillion. Next year, to 15.so trillion. That is how gradually they will be able to accommodate the entire amount that is in the long-term or medium-term planning process. So yearly, you need to have an effective yearly plan that will help you to achieve the longer plan we have talked about. Principally about planning, one thing you must be able to plan efficiently is cash. So let's look at cash planning. Cash planning is the same thing as cash budget. Anytime you hear plan, it is the same as budget. Budget is planning. But it now depends on what is the duration or term of your planning. If your planning term is long term, then you say it is a long term or strategic budgeting. If it is short term, then it is just an annual or cash budgeting. So these are the things that we find out under cash budgeting. The cash budget is the statement of the firm's planned inflow and outflow of cash. The firm's planned inflow and outflows of cash. When you say an inflow, it means money coming in. And when you say an outflow, you are talking about money going out. So the one that you are spending is the one that goes out, and the one you are receiving is the one that comes in. So you need to plan these things effectively. And that is why cash planning is important. Is important. Secondly, cash planning is used to estimate short-term cash requirements with particular attention to anticipated cash surpluses and shortfalls. If you have made a plan, it is not a guarantee that what you have planned, you are going to have that 100%. Let's say that you are into selling of electronics and you have planned that, this year I want to sell 50 million worth of electronics. It is not a guarantee that having attached a value to the amount, to the year's sales plan, that you're going to have exactly what you have planned. It is not something that there is a hard and fast rule on it. There are two ends to such planning. It is either you are going to have a surplus or you are going to have shortfalls. Surpluses is when you sell beyond the plan you have made. Let's say that you have budgeted, you have planned that this year you want to make a sale of 50 million naira, and you now make a sale of 80 million naira, for instance. At such time, we could say that you have had surplus. But at some points too, you may not even be able to meet up the requirement, the things you have budgeted for. Let's say that you have planned to make sales of 50 million and you end up selling 45 million. That will result in a shortfall. And when shortfalls are identified, then there is need for specific investigation into what caused the shortfall. Then, if there are surpluses, you also need to investigate to see whether you will need to expand your budget limits to know that if you have planned for 50, maybe you can make it 75 or even 80. Remember, typically of this kind of thing is what happens in Nigeria with the oil price. You know, Nigeria budget is always planned in line with oil price. Sometimes you will hear that there is excess crude account. Have you heard of excess crude account? Excess crude account is because what they have put as a threshold for sale per barrel in a year is now more than what they sold, is higher than the benchmark they have set. So when they have set a benchmark and they sold higher than that, then it is surplus. It is that surplus that you hear excess crude account. When there is deficit or shortfall, it also needs to be investigated. So typically, monthly budgets are developed to cover a period of 1 year. Anytime monthly budget, even in the yearly budget can also be broken into 12 monthly budgets, so that each month, you know, like in some businesses, it also depends on the season. In Nigeria, principally, we have two seasons. Either it is a dry season or a rainy season. Now, if your product sells more during the rainy season, during the dry season, or let's say during the rainy season, you should know when to enlarge it. For example, if you are selling something like umbrella, you know it will sell more during rainy season than in dry season. So there should be enough umbrella to sell during rainy season and maybe a reduced quantity during dry season. So these are the two ends that must be met. But for these to be achieved, It revolves around what they call budget cycle. What is budget cycle? These are the things that is made up of budget cycle. Number one, planning, performance planning. When we say performance planning, you need to check what you have done, whether it met up with what you have expected to do. Your expectation is your standard that you have set. I have set the standard of selling 50,000 tons of my product, and I end up selling 51,000 tons. So there is a surplus. So performance planning will help you to know whether you did well this year compared to last year, or you are doing well, or you did well last year compared to this year. In accounting, anytime financial statement is prepared, usually you must have a comparative year. The one for this year and the one, if you're doing the one of 2020, the one of 2019 must be placed side by side with 2020, because you want to use the one of 2019 to compare with that of 2020 to see whether you did well in 2019 better than 2020. So performance planning will help you to achieve this. Then the second thing is that you need to provide a frame of reference. You should be able to identify this area is where I need to give special attention. If it is a seasonal product you are selling, you also need to understand which season sold more. And you can now make a reference to that season and make products available for that season. And as we did mention, whenever you are doing planning, you cannot always achieve the expected result. It's not possible. It's either you will have a surplus or you will have a deficit. But when that occurs, what do you need to do? Investigate variation. The difference between what you plan and what you achieve, you need to investigate it. Upon investigation, you will see where you need to make corrections. So when you have investigated and identify the area you need to make corrections, then the next thing you need to do is to take that corrective action. Upon taking the corrective action, you have achieved a lot. You have started with planning performance planning. You have provided a framework of reference. You have investigated variation. Then now you have taken corrective measures. When you conclude that segment, you plan again. So that is why it is called a cycle. When you have finished one cycle, you start another cycle again. Continue to be planning performance, provide framework of reference, investigate variation, and make corrections. Continue to plan again like that and like that. So it continues to revolve. When you do that, performance planning and budget cycle would have been achieved. So these are the elements you find in strategy, planning, and budget. We have said strategy is a way of achieving an objective. This is the pattern I want to follow to achieve a set objective. So strategy needs to be analyzed. And upon analysis, you will now know whether your strategy falls under long run or long-term planning or short-term planning. If it falls under long-term planning, what do you need to do? You also need to have a long-term budget. If it falls under short-term planning, it means that you also need to have a short-term budget. So these are things that you do every day in the business. That is why the difference between a successful businessman and a person who is not successful is the way you plan. If you plan well, the business runs smoothly. You may not be there to be selling the product every day, but you are the one thinking for the business. You are the one making ideas for the business that will help the business to grow. This will take us then to money cycle. Money cycle, we are talking about the primary function of finance is movement of money from lenders to borrowers and back again. How does money move from lenders to borrowers? and from borrowers back to the lenders. Whenever you collect a loan, you use the loan. The person who issues the loan is your lender. You use the loan to run the business and you sell, make profit. When you sell and make profit, you carry the profit you have made back to the bank. The bank keeps the money again and give it to another person, and the person goes and sell and bring the money again, and it continues to revolve like that and like that. No wonder banks don't run out of money. It is because of this money cycle. So money cycle helps you to know how money goes round and round and round from the lender to you, the borrower. From the borrower, you send it back to the bank, to the lenders again, and they lend it again and continue to borrow and lend and borrow and lend. We have now talked about two of the aspects of our discussion this morning. We did mention that we were going to talk about understanding financial planning activities and differentiate between long-term from short-term financial plan. We have done that. So the next thing we want to look at out of the 6 items we said we'll be discussing today is understand reason for bookkeeping. What is bookkeeping? This may not be the first time you have heard the word bookkeeping. And if you are asked to define it, many persons know what bookkeeping is, that it involves the recording on daily basis of a company's financial transaction. With proper bookkeeping, companies are able to track all information on the books to make key operating, investing, and financing decisions. So, recording business transactions mostly in a systematic manner, you are keeping books. And sometimes, using this word bookkeeping, there are times we carry out these actions without knowing that what we are doing falls within the sphere of these languages that we are using today. For example, there is no one who is running a business that will not keep a record. If you don't keep a record, what will happen to those who bought on credit? Will you be able to collect your money back? So everybody must learn how to keep books. Bookkeepers are individuals who manage all financial data for companies. That is to mean that without bookkeepers, companies will not be aware of their current financial position as well as transactions that occur within the company. If you do not keep books, even decisions you are making will be faulty. No wonder it is always said that why you should sample opinions from people is to enable you make an informed decision. So business decision is always centered around operating decision, investing decision, and financial decision or financing decision. So operating decision, we have already talked about operating activities. Investing decision, it is long-term in nature, and financing decision, what is the source of fund? So we all need bookkeepers, but bearing in mind that bookkeepers in your business must not be an accountant. No. So you may not need to hire an accountant to keep books in your business. Even a school leaver can be a bookkeeper. No wonder accountants used to say, every accountant can be a bookkeeper, but not all bookkeepers are accountants. So you need people who will keep records of your business so that it will help you to be aware of what is the position of your business. If you don't keep books, you won't know whether you are doing well. And if you don't keep books, you will not know if you are doing poorly. So bookkeeping is an important aspect of business. But what are the importance of bookkeeping? Let me mention some of them as I have shown you on this slide. Number one is a reliable measure of company's performance. Bookkeeping helps you to measure your performance, whether you are doing well or not. Number two, it provides information for strategic decision. Strategic, I have mentioned that it is long-term decision. So it provides you with information that will help you to make long-term decisions. And thirdly, it provides benchmark for revenue and income goals. Where is the revenue coming from? Where is the income coming from? That is what bookkeeping will help you to achieve. So it is important that we keep books in order to achieve this. Then it also helps you to fulfill your legal and tax obligation. Your tax obligation is a legal obligation. But let me mention this to you in taxation. Bear in mind that government does not charge tax on losses. You must make a profit to be taxed. And if you do not keep books, you will not know whether what you have made is a profit or a loss. So the government is interested in your keeping proper records so that you pay an appropriate tax. And if you did not make if you made a loss, even the tax law allows you to net your loss against your future profit. Let's say, for example, in the first year you sold and you make a loss of 500,000. Next year you sold and you make a profit of 1.8 million. The tax law provides that upon computing what will be your tax liability for next year, you will compute your tax liability. That is, you will have a total profit of 1.8 million. Then you will remove the loss you made this year. And losses can be removed against profits into the future. So whatever loss you have made in the past, you will be netting it against your profit until all the loss is fully relieved. Then another importance of bookkeeping is that it provides stewardship to investors. You who are running the business, the investors are interested in how the business is run. So it is your records that will show whether you have done well or not. These books you are keeping, there are some that are required by law that you will publish if you are a limited liability company. For example, you have some financial statements we are going to talk about later that you must produce. And this financial statement you're producing is for the general public, including those who are your investors, those who have given you money. They want to know whether you are doing well or you are not doing well. Then lastly, bookkeeping will help you have proper management of cash flow. Cash flow, we are talking about cash inflow and cash outflow. So if you are keeping books properly, you will now know whether you should have cash on hand at any time or what you are having is excess. So bookkeeping is very important. In fact, it is as important as the business itself, because the success of every business is dependent on bookkeeping. If you're keeping your books properly, you are going to have a healthy business. But if you are keeping your books shabbily, you are not going to run a healthy business. So let's look at some terminologies that are used in accounting that can also help you to understand some ways you can make your books, keep your books properly. We are going to talk about accounting basis now. We have two that we will discuss, two simple bases of accounting. Although one is a little more complex than the other, but these are the two primary bases of accounting. Number one, cash basis, and number two, accrual basis of accounting. So let's talk about cash basis of accounting. In cash basis of accounting, you record transaction only when cash is actually received or paid. Let's say that somebody is owing you. There is nothing you are going to do about it. It is not going to be in the records because you have not received cash and you have not paid cash. But different from cash basis of accounting is accrual basis of accounting. What does that do? It records transaction when it occurs, even if cash is not received. Even if you did not receive cash or you did not pay out cash, accrual basis of accounting records transaction when it occurs. Let's look at some examples of these two bases of accounting. An example, you purchase 100 units of a product and would pay for next month. You have bought 100 units of a products you sell, and you are going to pay for it next month. How would cash basis of accounting treat that? In cash basis, no transaction is recorded. Why? Because you have not received cash and you have not paid out cash. But in accrual transaction, in accrual basis of accounting, it will record the transaction through an account payable, and which is a liability account. When they say account payable, those you are owing. Prior to this period, we used to call them creditors. But this word used here has helped to shed more light on it, that they are account payable, something you are going to pay, even if you have not paid it. So whenever you have an account payable, it means you have a liability, you have an obligation that you are going to pay in the future. This will now take us to methods of bookkeeping. We are still talking about bookkeeping, and then the fourth thing we said we were going to look at is identify bookkeeping methods. So bookkeeping methods is the fourth aspect of our discussion out of the 6 aspects we said we were going to talk about today. So in bookkeeping methods, we have 2 methods. 1, single entry bookkeeping, and 2, double entry bookkeeping. What is single entry bookkeeping? Single entry bookkeeping is a straightforward method where one entry is made for each transaction in the books. Anytime there is transaction in the books, one entry is made for those transactions. You are talking about single entry bookkeeping. Then a more robust method of keeping books, which I will encourage you to use, is the double entry bookkeeping. Double entry bookkeeping is more robust. It follows the principle that every transaction affects at least 2 accounts, and they are recorded as debit and credit. You may have heard accountants say every debit entry must have a corresponding credit entry. So, and you must have heard people say debit the receiver and credit the giver. So every account under double entry bookkeeping must have 2 transactions recorded. 1, the giver, and 2, the receiver. Let's look at an example that will help us to shed a little more light on this. If you sell a bag of cowpea for 20,000 naira, you sell. So when you sell, what will happen? You will receive cash. And we did mention that you are debiting the receiver and crediting the giver. So you that is receiving the money, what represents you is your cash book or your bank account. Because whenever they give you cash, you are entering it in your cash book. If they give you a check, it is going straight to your bank account. So you that have sold something, what you gave is a product and what you receive is cash. So that cash will be debited because you are the receiver. Then you will now ask yourself, from where did I receive this money? I made sales. So you have to credit your sales account. Anybody who comes and look at your account, they don't need to ask you any question. No. What they will just do, you have 20,000 in your account. Where did you get this 20,000 from? They will see sales account credit. Oh, you sold something. That is it. So double entry bookkeeping is a little more complex than single entry bookkeeping, but it gives you a proper view of your financial status. Then there are different systems of accounting. We will talk about some of 2 of them here. Accounting system, we have manual accounting system, and the second one is computerized accounting system. Remember that manual accounting system are accounting system that is processed by hand. When you use your hand to record, to write, they will say you are operating a manual accounting system. But if instead of using your hands, you rather use your computer, you input the information into your computer, then you are operating a computerized accounting system. So when you do not use hand to process it, you are rather using computer program. So programs are available that you can use. There are lots of computer programs that you can use to operate your business. But even while you may need a computer for you to have an accurate result, let me give you an example of what happened last week. Somebody used Microsoft Word to type a series of numbers, amount of money, and when he finished, he used calculator to add them, add them, add them. When he finished adding them, he put the total figure there and signed it that this is the total. Then the money was sent, the information was sent to me, and I picked each of the figures and put in an Excel. You know, Excel automatically you can sum everything. Upon summing what they have done, you see that the figure is completely different from what they use manual hand to count. So that is the beauty of computer. If you're using a computer to do your operation, it will be easier for you to sum, it will be easier for you to add, it will be easier for you to divide, multiply, whatever thing you want to do, whatever operation you want to do, you can do it easily. So that is why the computerized accounting system is a good way of running your business. But don't forget, there is this word they use in computer, they call it GIGO. You must have heard that. Garbage in, garbage out. What does that mean? It is whatever you input into the computer that the computer will give you. So it means that if you input the wrong figures or wrong amount into the computer will give you the wrong amount. But if you input the right amount into the computer will give you the right amount. So it then calls on us to have basic understanding of the bookkeeping behind what you input into the computer. So you need to know these things that we have talked about, like when we say garbage in, garbage out. If you know that every debit entry must have a corresponding credit entry, and where you have entered in the computer was on the debit side, that will just guide you that no, the next entry will be on the credit side. Like that one we did there, you enter the debit 20,000, you enter the credit 20,000, account balance, everything is okay. But if you do not know the bookkeeping behind what you are doing, it will then mean that you can enter the two figures on the debit side. And when you do that, instead of having 20,000 naira as a cost of sales, that's the amount you sold the copy, you are going to have 40,000 naira. And that is because you do not know the bookkeeping behind it. So that is why being here is very, very important. Now, for every accounting operation all over the world, every accounting operation all over the world, all accountants use a set of rules to prepare their financial report. And this set of rules that they use is called generally accepted accounting principle. Generally accepted accounting principle. That is why if you do your accounting here in Nigeria, you travel to another country, you will see that it is the same debits and credits you were doing in Nigeria, you will do in that same country. Why? It is because all accountants prepare their financial reports in the same way. Although this generally accepted accounting principle is guided by sets of rules called international accounting standard. Then before now, every country have people who provide the standards they operate with. Even in Nigeria, I remember those days when we used to have Statement of Accounting Standard, SAS. But from 2010, Nigeria adopted International Financial Reporting Standard. And for that adoption, it now means that what we are doing in Nigeria now is what they are doing in every other country around the world. So we are now on the same page. And those who are responsible for ensuring that we follow the rules set out in this report, in this accounting principles, is called Financial Reporting Council of Nigeria. Before now, the people who were responsible for ensuring that we follow the rules set out is called Nigeria Accounting Standards Board. So these are people who are there to ensure that these accounting reports you are producing should follow the same sequence, so that you are not producing something different from another person, and another person will not be producing something different from another person. So financial reports is a summarized information about the financial status of the business. Financial reports, there are two sets of persons that prepare financial reports. One, the financial accountant, and two, the management accountant. Now, management accounting deals with providing information for use of management to enable management take decision for the business. Whereas financial accounting is producing information for use by parties who are interested in the business. They are called stakeholders. You may have heard the word stakeholders, not just today, many, many times. But who is a stakeholder? A stakeholder is anyone who can be affected or affect a business. If the business operation can affect someone, let's say the person is living in the environment where the business is, and the business is a threat to the person is also a stakeholder in the business. And if the person can block your gate and say you won't enter unless you settle us, as we used to have in some places in some oil producing states, if it happens like that, the person is equally a stakeholder. So anybody who can be affected by the business or can affect the business is a stakeholder. So financial report goes to those persons who are in need of this financial information. But for you to produce this information, you need to use the language of the business. You do not need to use language outside the language of the business. And language of the business is accounting language. So if you're preparing the financial report, you should prepare it with financial language. So I have mentioned this in passing when I talked about financial accounting. I did mention that it focuses on reporting information to external users, those outside the business. Even those who are inside the business that are stakeholders to the business also benefit from financial accounting. Then managerial accounting is focusing principally on preparing financial information for internal users or management use. If you don't call it management accounting, you can also call it managerial accounting. Then who are the persons who uses the accounting report? We did mention that some are used by outside persons, while others are used by those within the business. So who are those outside the business that needs the business information or accounting report? One, the government. Two, the general public. Three, civil society. And four, the lenders. So all these persons are affected by the business. The government, the general public, the civil society, and the lenders. They are people outside the business, but they are interested in the financial report produced by the business. What kind of report do you produce for these persons that we have mentioned? We have the statement of financial performance, the statement of financial position, the cash flow statement, statement of changes in equity, and the notes to the account. These are the things that external users of the business need for them to know how your business is doing. But why does the government need your financial report? Government needs your financial report so as to know whether what you are paying as tax is the appropriate tax you are expected to pay. So they want to also ensure that your business follows ethical rules that they have produced to guide your business operation. The general public. The general public want to know whether what you are doing is a threat to the environment. For example, those who are into oil drilling, those who are into drilling of oil, like those in the Niger Delta, for example, there is something they call gas flaring, where they will flare gas into the air. And when it rains, you will see dark smoke coming from the weather. That can be very poisonous to the people. So the general public in the environment can fight for that and say, please, you need to check how you are operating. There is something that is encouraged all over the world. It is called greenhouse emission. So that instead of you to emit gas into the air, that you should rather recycle it and use it for something else. Then the civil society, just like the general public, they also want to ensure that the government does what is right or the business does what is right. You may have heard at some times when Amnesty International will say, we are giving you ultimatum to do this and that. Or the labor union will say, oh, you cannot do this. You need to increase our salary. You need to do this or you need to do that. So all these are persons outside the business who also check the financial report of the business to know how it can add value to them. Then the lenders, those who give you money, they want you to pay interest on what they have given you. And they also want you to pay back the capital as at when due. So they also are interested in the operation of the business so that you fall within the scope of what is expected. So they will need to pick your financial report and check whether your business is healthy enough to continue running or not. Then we now have individuals inside the business. Apart from those outside the business, there are people inside the business that are also stakeholders in the business. The people inside the business who are stakeholders are the shareholders, the managers, the employees. Shareholders are those who invest their money into the business. They are the real owners of the business. So they want to have a return on investment. Return on investment may be in form of dividends. They want the business to declare dividends and give them something. Or they want capital appreciation. What they have invested should grow. That is the shareholder. So they are interested in the business. They want to also be sure that those they have handed the business over to, which is the managers, are running the business effectively and efficiently. Then the managers, they are interested in the business. They want to secure their job. They don't want anything to happen to their job. And if they are running the business in a healthy way, they can also ask for an increment, bonus. They can ask for that. So they are not external users of accounting report, but internal users who also need the information to guide them on what next to do. Then we have the employees. The employees, if the business is making enough profit, they can ask you, please increase our salary. They are also interested in the security of their job. They don't want job that tomorrow they will not have another one. So they want job security. So all these people who are users of financial statement are interested in it for reasons that are beneficial to them. So now let's take a look at primary accounting reports. I have mentioned these in passing before, but let me mention the ones that are here again to you. The primary accounting reports is in form of balance sheet. The name balance sheet is now called statement of financial position. Then income statement or statement of financial performance. And the last one is cash flow statement. These are three primary accounting reports. What is a balance sheet or statement of financial position? Statement of financial position tells you the company's assets and liabilities. It is not an account. Balance sheet or statement of financial position is not an account. It is a statement that shows you the assets and liabilities of the business. And there is this thing we call accounting equation, where we say asset minus liability gives you equity, and therefore liability plus equity is equal assets. That is why the two sides of the balance sheet must always balance. So balance sheet is one of the principal statements that is used for the business. Secondly, we have income statements. Income statement tells you how much the business have sold and how much expenses they have made. When you have sales, you have made sales, and you now remove expenses, including the purchase, the money you use to buy the goods from the expenses, from the sales you have made, whatever is left becomes your income or your revenue, or it now becomes your income. For example, you bought a product worth 100,000 naira. You sold it for 180,000 naira. And upon selling it, you made expenses of 60,000 naira. So 60,000 naira plus 100,000 naira gives you a total of 160,000 minus 180. You are going to have 20,000. So 20,000 becomes your profit after you have removed your expenses from your sales. So that is the income statement. It's just showing you what you have as income and what you have as expenses, what you have as sales and what you have as expenses and what is left for you. Then lastly, the cash flow statement. Cash flow statement is a statement that shows the liquidity position of the company. It is looking at cash inflow and cash outflow. And if you remove cash inflow from cash outflow, what you have left is cash and cash equivalent. So this is a typical example of how the balance sheet looks like. You can look at your screen to see how the balance sheet looks like. You will see the liability. Under the liability, you see the equity. And then on the right-hand side, you see the assets. So this is how a balance sheet looks like. And then for income statement or statement of financial performance, I told you that you have your revenue, you remove your expenses to have your profit. That is what we have just displayed here, where you see the revenue up and under it you see expenses. So expenses is removed from the revenue for you to have a profit. So this is now a typical example of how components of the balance sheet. This balance sheet you can see here is a typical example of how the balance sheet looks like. Under the balance sheet, there are different categories of assets. We have the current assets, we have the non-current assets, and then we now have other assets. Now, under current assets, we have cash and cash equivalents. Then we have receivables. Account receivables are those things that the people are owing you. The one we used to call debtors before is what you have under cash and cash equivalent. Then you have the inventory. What you bought that you have not sold becomes your inventory. Then prepaid expenses, what you have paid in advance. And if there is an investment in another company, it becomes your investment that you have there with $10,000 as a price. Then under that, directly under that, you will have your non-current asset. Under non-current asset, we have property, plant, and equipment. Now, land is there, $24,300. Then building and improvements are directly under that. You will see equipment, they are under that. Less accumulated depreciation. Accumulated depreciation is the depreciation that you have had from the first day of buying the asset till present. So now land is not depreciated. That is why in accounting, land is called non-depreciable land. Why? It only continues to appreciate or grows over time. So that is why land is never depreciated. So when you remove the depreciation, whatever you have left will become the carrying value of the asset as at the time of the report. Then under that, you will see other assets. Other assets like intangible assets, patent rights, they are intangible assets. Then less accumulated amortization. When an asset has physical substance, like the one we call non-current assets, if there is an asset you can touch and feel, reducing the value of such asset is called depreciation. Whereas the one you cannot touch and see, like patent right, goodwill, they are called amortization. So you amortize an intangible asset and you depreciate tangible non-current assets. That is just the accounting language that is used with that. Then on the other side of the balance sheet, you will see the liabilities side. Liabilities also starts with current liabilities. Look at it that the total asset in this question is $472,100. Then on the right-hand side, which is now the liabilities, you will now have what form the categories of liabilities. Current liabilities, we have account payables, those you are owing, notes payable, accrued expenses, expenses you are owing, deferred revenue, revenue that is put forward. Then under that, you have long-term debts. Then you will now see shareholders' equity, where we have common stock, additional paid-up capital, retained earnings, and treasury stock. So when you add all of them together, you are going to have a total of 472,100. Mr. Abdullahi, sir, do you want to ask a question, please? You are muted. I can't hear you. Can you unmute, please? Yes.
Hello.
Yes, I can hear you now.
Yes, sir. Are you hearing me, sir?
Sorry?
Hello.
Yes, I can hear you.
Are you hearing me, sir? Okay, I see my question, and I don't know whether if I get charges more, I will come out and meet the lecture.
Sorry? Come again.
Hello. I see about to shut down.
Your network is very poor, so I can't hear you at all.
Okay.
Okay, why not you just hold on with your question? Maybe when we round up, whether your network would have been improved, I will take your question. Mr. Anthony.
Okay, no problem, sir.
Sorry? Okay, again, you can also type the question you want to ask and send it in the chat. Mr. Abdullahi. Did you hear me? You can type the question. Yes, yes, sir.
Yeah, you heard me.
Yes.
I want you to explain more about these other assets, this intangible asset and then amortization.
Okay.
Yeah.
Intangible asset, as I have mentioned, there are some assets you cannot see or touch, like patent rights, for example.
Okay.
They are called intangible assets. Any asset without physical substance, you cannot see, you can only feel it.
Okay.
Like goodwill. Nobody sees goodwill. Sometimes purchase goodwill is only when the company is sold. You can say, there is a purchase goodwill of so amount.
Okay.
Ahead. So every asset is expected to be depreciated.
Yeah.
Ahead. If it is a tangible asset like building, equipment, motor vehicle, all those ones, when you are reducing their value, the depreciation is a systematic allocation of the amount of the asset over the useful life.
Yeah.
So the same thing applies to intangible asset, but instead of calling it depreciation, you are rather calling it amortization.
Okay.
So tangible assets depreciate, intangible asset you amortize.
You amortize.
Yes.
Okay, it's all right.
Okay,
But are you lessing the amortization?
Yes.
Which means the amount, any percentage that you allocate for these intangible assets. Then you now, when you do the percentage of the amortization, you now less the amount.
You know, like depreciation, there are different methods of depreciation.
Yes.
Where you have a straight line method, the reducing balance.
Yes.
So it now depends on if you amortize, if the amortization comes in two ways: intangible asset with finite life,
Okay.
and intangible asset with infinite life.
Okay. Okay.
So it depends on what kind of intangible asset you have to know what will be the rate to amortize it.
Okay, that's okay.
All right.
Okay. Thank you very much.
Okay, sir. So this is an example of the income statement we have mentioned. You remember when I told you about statement of financial performance, I said there must be a comparative year. So that is what you have there. You have the one of 2004 and the one of 2003. So 2003 is now the comparative year to 2004, where you have the revenue. You will have first what forms the revenue, the total sales of the business. You have revenue from services, sales, professional consultancy. Then the total becomes your sales. Then less your expenses. The total expenses comes from wages, which is salaries, marketing and advertisement, rent, utilities, membership and publication, insurance, consultancy, office supplies. Those are consumable supplies, because if you're buying something that can last for a longer time, it will fall under capital assets. So when you put all the expenses from the revenue, the total revenue, you see the total revenue is $302, 553, $302,503. Then the total expenses is 247,800 for 2003. For 2004, you have 339,490 and 262,200. So if you remove the expenses from this revenue, you now have an operating income. It is on this operating income that if there are other operating gains like interest income, loss on sales of assets, donations or gifts, you will now remove those ones, and whatever you have at the end of the day becomes your net income. If there is a provision for income tax, you also need to disclose it. But remember, I told you that income tax is only paid when you have a profit. So if you made a loss, you are not going to pay income tax. Then let's move to other comprehensive components of. Let's move to other components of these financial statements, where we have assets, liability, equity, revenue, and expenses. These are the things we've already disclosed to you in that account, in those financial statements we have looked at. So, but what would be the effect of each of these things on the account? Well, accounting is a process of recording business activities that make changes to account. And this includes sales of a product, revenue from services, and buying products and other services, incurring other expenses, depreciation of fixed assets, closing books for the year. At the end of the year, each of those ledger items, you have to close them. And when any of these and other business activities are recorded, accounts changes in value. How do they change in value? These are the next things we want to look at. This still typifies what we have told you before about expenses and income. But let me take you to this side that shows the effect of each of those actions on each of these statements. So for balance sheets, if you want to increase an asset, you have to debit the assets. If you want to increase revenue liabilities, you will credit it. Anytime liabilities are credited, it increases in value. And anytime equity is credited, it also increases in value. If asset is debited, it increases in value. The same thing goes to income statement. If income is credited, it increases. If expenses is debited, it increases. There is this thing I use to help people to see how they can understand these this effect on accounting statements. The word real, that is R-E-A-L. If you use the word real, it can guide you to know when to debit and which one to credit. Real, R is for revenue, Y-E is for expenses, A is for assets, and L is for liabilities. So if you have that, if you take that down, real, R for revenue, E for expenses, A for assets, and L for liabilities. Now, this is the effect. Revenue, if you want to increase it, you credit it. Expenses, you debit it. Assets, you debit it. And liabilities, you credit it. So you are having credit, debit, debit, credit in real. That is just the effect on these income statements and balance sheets. So if you're having an asset, you know it is going to be debited if you want to increase it. Now, the reverse of this becomes if you want to reduce their value. So if you want to reduce their value, for example, if you credit asset, automatically the value of the asset drops. If you debit a liability, automatically the value of the liability drops. And if you debit equity, the value of the equity will drop. If you debit revenue, the value of the revenue will drop. And if you credit expenses, automatically the value of the expenses will drop. So this is exactly the effect of all this on the financial statement. I want to thank you very much for your patience, even while we did not start so much early this morning as usual. We appreciate your time. Please, if you have any question, even if it did not bother on what we have discussed today, kindly feel free to ask your questions. And if it is questions on accounting, principally, if it is question on accounting, whether it relates to this or not, we'll be willing to answer it for you where we are able to. Yes, sir, Mr. Anthony, sir. Please unmute yourself so we can hear you.
Are you hearing me?
Yes, very well.
I say in the accounting of this thing that you put, I saw the position of dollar not being on top of those figures there. Is that the new way of arranging it?
No, it is just computer typing.
Okay, it's all right. It's okay. I'm okay.
All right, sir.
All right.
Any other question? Okay, Madam Gift. All right, if there is no other question, your quiz will be sent to you in a short while. You can do it and submit it. I'm told that it's already submitted on the group, so you can answer the quiz question and submit it. And if there is any need for further information at any time, you can feel free to get back to us to answer your questions. Thank you very much for your time. We appreciate it.